apart from metals, it's the financials which continue to be the talk of the town. So let's welcome on board Mr. Girish Kousgi, the MD and CEO at PNB Housing Finance, joining us on the show. Girish, hi, good morning. Thank you so much for making time and speaking with ET now. Just wanted to begin by understanding what's happening with respect to loan growth, because if I have it right, the annual target that you had suggested for the year was a growth of around 17 to 18%. But this quarter, it was a little slower at around 11%. We do understand the seasonality, but would you be confident about that target of 17 to 18% growth?
Good morning. I think if you look at any year, quarter one would be muted, both in terms of asset quality as well as growth. So 11% growth on book is in line with our expectation, and the guidance, for the year is about 17 to 18% of book growth, and we are pretty confident because this is something which at least I am seeing for last over 20 years. So quarter one would always be muted after a very good quarter four. I think in any year, quarter four is the best quarter, and after that quarter will be muted, and again it picks up from quarter two onwards. So if you look at demand is quite robust. We are seeing good traction across. It's only because of seasonality the book growth is 11%. But if you look at 11%, this 11% book growth is the highest in last 15 quarters. And if you look at last couple of quarters, both the book growth and disbursement, it has been really amazing.
Okay, you sound very optimistic. So, Girish, given the fact that there is a report that recently suggests that affordable housing continues to languish and you forayed into this segment, take us through how you have performed so far and what is your projection going down the line? Are you as optimistic?
I think if you look at the market and if you have to segment between both prime and affordable, I think affordable constitutes to close to 35 to 40%. And for us, at least, quarter one was very good. We showed a growth of 66% over the previous quarter. And we are pretty bullish on affordable and prime both. Yeah, there are reports, which talks about affordable demand slightly going down. Again, I would assign this to seasonality. Otherwise, if you look at the entire year, whether we look at short term, mid term, or long term, both prime and affordable would offer good opportunity in terms of demand.
Okay, sure. But there's also that component that a lot of these companies, HFCs, have been facing a lot of competition from banks. So how competent are the yields that you will be charging on the incremental loans that are being disbursed?
I think if we talk about competition, basically there are four segments: super prime, prime, affordable income based, affordable informal based. So if you look at super prime, that is where there is competition more by desire. So most of the banks would want to focus on super prime, where it is more by desire, and affordable is more by design. So we are very clear. Our focus is very clearly on the prime and affordable income. In these two segments, though there is competition, we don't see a significant competition, and therefore, it really fits into our scheme of things in terms of growth as well as profit.
Okay, so that's the take coming in. But I just wanted to understand that going forward with respect to the profitability and cost of funds, etc. as well, given all of those dynamics, what's the expectation of how the net interest margins, etc. would shape up?
In terms of margins, both spread and NIM would be in line. So we had guided for 2.5% spread and 3.5% NIM. As of now, we are at about 3.86% of NIM. I think this will be sustained, for next few quarters. I think on margins, we will be able to sustain, based on what we have guided. In terms of growth, I've already mentioned. And in terms of revenue, there'll be a good upside for next few quarters because the rates started going up last year, and this will now consolidate for next 2 to 3 quarters before it starts going down. So I think next few quarters is going to be really good for HFCs and NBFCs.
What about a very basic question that if I look at rural economy, all data points are indicating that there is a slowdown. Cement companies are saying the same, auto companies are saying the same, even retail companies like V-Mart and D-Mart are saying that rural economy is slowing down. Won't that impact your demand? Won't that impact housing demand and cost of affordability eventually?
Actually, if you look at the entire industry, all the institutions, both in formal and informal segment, they're not really catering to rural per se in a big way because of the challenges, on collateral zoning, etc. So I think the focus today, if you look at any company, is going to be probably in top 200 or 250 locations, which is top cities and next few towns. So I don't see too much of a challenge because the focus really is on urban and semi-urban. We call it as tier two, tier three, tier four. I think in these locations, which is not actually rural. So very few companies, to a very small extent, would focus on rural. But given the challenges in this industry in terms of various approvals which is required and the zoning regulations, not many companies have really ventured into it. Probably, I think 10 years from now, rural also would start contributing, but at this point in time, it is more to do with metros, top cities, and small towns, which is tier 3 and 4. So I don't see any challenge because of rural really not contributing, at least in the formal sector.
Builder loans. What about loans to developers? Are you looking at expanding that? Because if I look at the metros, the demand for urban housing, the channel checks indicating that the Indian urban buyer is looking at buying more houses, and developers are also saying us this, telling us the same thing.
Yeah, if you look at the real estate space, it is doing pretty well since last 2.5 years, immediately after COVID, which is from 2020 October onwards. But yes, our focus as of now is to grow retail. A corporate book, consciously we are degrowing and we are working on resolutions. We still have a bit of work left in terms of working on resolution and bringing down the NPA, even though I think corporate, which is funding to developers for projects, offers good scope for the HFCs. We would not be really focused on that for next few quarters. Our focus is really on retail, within retail, on both prime and affordable.
Focus continues on retail, but just wanted to get a sense from you about the asset quality because, of course, in the quarter gone by, you've managed to show a bit of an improvement. But how's the asset quality panning out on the incremental loan book going forward, and what's the internal target?
All the early warning signals on the incremental book, what we're building, is very, very encouraging. Having said that, we also have to deal with the portfolio what we have. I think we have very good traction on that. And probably in next 4 to 5 quarters, our asset quality would be comparable, with some of the best companies in the industry.
Coming in as far as PNB housing is concerned, but just sir, also a word on the return on asset because it's already at a decadal high if we have it right. Could you talk to us about what will be the normalized return on asset going forward as well?
See, our focus is very clearly on few pillars. So starting with asset quality, profitability, growth, and liquidity. Now we have a mix of both prime and affordable. Prime will help us to grow the book faster. Affordable business would help us to improve our yields and thereby maintain margins or rather probably further improve. So I think looking at next few quarters, our return ratios, including ROA, would look very, very good.
So that's a word coming in. The ROAs are looking good, not too worried about the asset quality. And of course, this quarter, the seasonality came into picture for loan growth, but on track to achieve the targets that they had set out. Thank you, Girish, for joining us and speaking with ET Now. A quick look at the markets before we head into that short break. We have Nifty, which is at 19,685 thereabouts, not managed to scale 19,700 yet. We'll do one thing, we'll slip into a very short break, but don't